if you ask me, I would rather own a house than own S&P 500 shares, or of course, it's an index, but or any company that isn't part of that index. And so I don't know. That's my general view on that. I think house prices can do very well. I bought a house in Latin America just because I think that the wealth effect that we may see in that area could be transformational for real estate investors.
Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. Today we have Tavi Costa of Crescat Capital. Tavi is known for sharp analysis of global economic trends and deep dives into commodities, precious metals, and emerging markets. With the data-driven contrarian approach, Tavi regularly challenges mainstream narratives. Today we're going to pick his brain on precious metals, battery metals, oil, Brazil, and China. Tavi, thank you for coming on the show.
Steve, thanks for having me. Looking forward to this.
Yes, we are as well, sir. Pleasure's all on this side of the table. This is your first time on the show, so let's start off by telling us your story and how you got into investing.
All right. Born and raised in Brazil. Grew up in a very entrepreneurial family with my parents owning a small business and seeing that go from very successful to nothing, essentially. And moved to the U.S. on the dream of starting my educational role here in the U.S. with a basically getting scholarships to play tennis in college, which was my bridge to get into America. After all that, and after doing college, I started to get into finance, and from there, basically started to work on investment firms and end up landing a job at Crescat. And from there, I went from an analyst to become a partner. And now more and more involved with even my own investments as well. And we've been part of the leverage buyout of St. Cristobal mine in Bolivia, which is now the fourth largest silver mine in the world. And also involved with a lot of investments in the mining industry. But at the core values of my investing career, I've been always a macro person and a value investor. So I study macro economics a lot. It's where I try to identify the bigger trends that will likely be in place for the next 5 to 10 years, and then I try to express those views in the markets as well as I can. So yeah, and I think over the years, lots of my macro analysis have gotten around, and but that's really where the core principles of my investing career really rests on.
Interesting. I knew you were from Brazil. I didn't know you came from an entrepreneurial family. What business did they have? What lessons did you get when you said they went from a successful business to basically close shop?
Yeah, so basically, my parents. I grew up, basically with my parents scaling up a business that they had was they had a few stores at the time that were selling clothing for kids, and essentially they had a representation of different brands. Um, when I say scaling up, they only had a few stores when I was born, and over the next decade and a half, they basically built up to having multiple stores in different parts of Brazil. When China began to export products overall to Brazil and the rest of the world for much cheaper prices, essentially killed the margins of the business. And my dad didn't see that coming, and he was still leveraging his business in a large way. Essentially, he was forced to close a lot of his stores all over the country. So we went from what it used to be low middle class to an emerging rich family to nothing, because my dad basically was not able to manage risk well at that time, basically end up losing everything. So from there, my dad inherited a farm, and he went back to opening a small business that was related to his farm. And I went through that in my teenager times. And so money became sort of more of a seeing the ups and downs of that. I mean, it became more of a security aspect that rather than something I would be thinking about as showing off or anything along those lines. And so it changed your perspective of life. I think every time I make money, I always think about not only the good times but the losing times as well. And so it changed my way of thinking about risk. But also, I come from nothing essentially, and so for me, when you have that perspective, you also tend on lean on confidence a lot more because anything that comes from here in terms of building value, building wealth, is a win. And so I take that with pride, and I've been working really hard to be where I am, and this to me is just the beginning.
Awesome. That's an interesting story, and I could definitely see how that shaped who you are today. Okay, and a semi tennis pro as well. Didn't know that.
Yeah, I didn't tell you much about that, but basically, when my dad lost his business, and I was probably in the early teenager times, I fell in love with tennis and realized that, at some point, I realized that tennis could be my bridge to the US. It was a way where you can get scholarships and play tennis in college, and my parents could never afford college here in the US for me. So, I put 8, 9, 10 hours a day almost on tennis, believe it or not, just to get to the level that I could to get my scholarships. And once I moved to the U.S. and did my 4 years of college playing tennis, and then that's where from there I basically got it's a long story short, but I got a few opportunities with the vice president of the school at the time who allowed me to basically move away from tennis to help him. And at some point, I was able to move into finance. And so, but that's essentially my kind of story and how I transitioned into the business world. But really started on family, and then tennis, and then here I am.
That's cool. That is cool. Okay, let's start off macro view. I like to ask all my guests this is what is your macro view of the world economy and financial markets today?
Lots of things. I mean, it's I used to say that a lot of my views rest on what monetary policy and fiscal constraints are going to be. And I think that that's really, where a lot of macro trends are likely to be developed from. And the U.S. is facing a real fiscal and monetary constraint. I mean, we're basically seeing so much fiscal spending over the years. At the same time, we're in a situation where interest rates are really likely to be pressured a lot lower. And the dollar has been in one of the most expensive levels we've seen in history, even with the largest decline since the 1970s. And so you can kind of imagine a world where suppression of rates is going to likely take place in the next 5 to 10 years, and the dollar would be a lot weaker. And as you see those two factors, and this dynamic is likely to be big beneficiaries of a few investment asset classes. I would say that commodities, given the fact that we've seen so much also depression in regards to capex, capital spending of resource companies. On top of those two dynamics I mentioned of suppression of rates and a weaker dollar, is likely to create a real super cycle for tangible assets, and commodities being one of the ways to express that view. Number two, I think there's going to be a lot of real big rotation out of US based assets into other parts of the world, and very likely to see emerging markets do quite well this next 5 to 10 years. That is a reason why, after living in the U.S. for so long, I've actually purchased real estate back in Brazil and started to probably going to live part of the year there, because I do think we're going to see a real trend of capital going back to Latin America specifically. So yeah, those are the two biggest macro opportunities in my view. And you can talk about the bearish side as well and other things, but I think the real money is going to be made on those two big trends, the hard assets and emerging markets. And so this is where most of my focus is at the moment.
Okay, so basically, in a nutshell, you see a weaker dollar, which when you have a weaker dollar, the price of commodities go up because with more dollars in existence, it takes the same takes more dollars to buy that same barrel of oil or that same ounce of gold. You see a suppression in interest rates, and that in turn will cause a rotation out of U.S. investments and into emerging markets.
Yes, and historically speaking, what's been happening, especially with commodities, is has a lot to do with what happens with gold specifically. Gold is sort of the leading um, I would say the leading, you call it commodity or currency, the leading hard asset indeed when it comes to attracting capital into that realm of assets. We've seen gold take off and make new highs and so forth, and I think that that's just a leading indicator to what's probably going to happen with silver, other metals, agricultural commodities, most likely resource businesses and so forth. And so I think there's a lot of catch up to happen in other places. And I would say that the weaker dollar is, or I should say that the strong dollar that we've had over the years, not this year, but over the years, has been one of the main reasons why we haven't seen the full transition into a world where a stronger gold price tends to take place. When you tend to see a gold price that is in a secular bull market, we usually see as well is also a weaker dollar over the long term. You also see a reemergence of other parts of the world relative to the US. In other words, something that is almost unthinkable today would be European equities outperforming US equities and things along those lines. I think all these things are very possible, very open-minded to investments outside of the US outperforming US itself. And so I think we're close to the end of American exceptionalism. I think American exceptionalism rests on the case of fiscal stimulus. I think we are unlikely to see the same degree of a fiscal stimulus we've seen over the last few years. And so, especially in relative terms, and all these things are going to have an impact on growth and are going to have an impact on assets that are asset performance in general as well. So lots of things to unpack. I mean, these are not going to be. I think there's a lot of ways to express those views here, but I just happen to be very bullish on commodities because I think there's a lack of attention in that space. And one of the things I learned is that if there's reasons to be a contrarian, and you just don't want to be a contrarian for the sake of being one, but if there are very strong reasons to be one, and the prices are reflective of those reasons as well. In other words, things are extremely undervalued, and you can take a constructive view on a certain sector or industry. This is the time to be doing that. And so a lot, deglobalization is probably going to take place. We're going to be in a more inflationary era. Onshoring is going to be a huge aspect in the US. We're going to see electricity consumption take off and so forth. All these things are going to be linked to the idea of materials, of commodities, of raw materials, of hard assets. And so it's going to be I think it's going to be all in highly correlated to those trends as well.
Okay. All right. Got some listener questions here, and one of them here is from Nautica. He's asking about, I'll share my screen here, and this is the gold to silver ratio. So we had a nice little spike up here where it took, over 100 ounces of silver to buy 1 ounce of gold. We've since come back down here to 87. He's basically asking, how low do you think this ratio will fall? And I guess it's a bit of a crystal ball question. When do you think this will happen?
It is a crystal ball question. At the same time, we can also say the history also plays its course in terms of we've seen this before, and we've seen that the extremes in gold to silver ratio at some point come back to their historical levels, but also overshoot to the downside. And usually we see the 20s and 30 levels be achieved. And so I do think that I wouldn't bet against that. I do think we're going to go to those levels at some point. There are charts that goes back, 300 years of this ratio. It is certainly possible to see those numbers at some point. The main reason for this is because we've seen gold take off, but usually what leads the market on the upside of a gold secular bull market really is silver. And we haven't even seen silver really take the lead here. Recently, as you mentioned, we've seen a decline of the gold to silver ratio, but that's just the beginning in my view. We haven't seen really anything yet. I do think silver will probably reach prices that are much higher than its prior historical highs. In other words, the $50 level is going to be taken out, and we're going to see new highs in silver prices, in my opinion. So I operate under that assumption. I've been operating under that assumption for some years now. Therefore, the reason why we decided to buy a large silver mine. When I say buy a large silver mine, we're not just buying shares of a company. We actually operate the business. We did a whole leverage buyout of the company. And the main reason for that as well is because as a contrarian at the time when silver was trading at what, $13-15 an ounce, nobody wanted a silver mine, and we clearly saw that this bull market in gold would ultimately translate into strong silver prices as well. And here we are, but I don't think we've seen anything yet. I do think that that's just the beginning, and any investment that has true exposure to silver in terms of leverage, of course, taking risk into account, I think are places that deserve more our capital in terms of allocation. So it's a place that I've been focused on, and I do think silver is one of the cheapest metals on in the periodic table and and on Earth in general. Yeah.
Okay. All right. So this little correction here from 107 down to 87 is child's play. You're looking down here in the 20s, 30s, and 40s ratio. You think it could get down to back down there again?
I do. I
Okay.
think that, a lot of people look at my charts and ideas and try to, day trade these ideas. And if you are doing that, that's in your own risk. That's certainly not what I'm doing with my own data. Um, what I'm trying to do is build wealth over the long term. And I think there's, you look at prices, for instance, of Hecla, specifically, just because it has a long data. You go back, I don't know, 1980s or so, and you look at the chart of that. I mean, it's at a major resistance right now. When we
Yeah.
break from there, I think it's going to accelerate to the upside. And all these things are linked to silver prices, obviously. I'm not picking on Hecla alone. I mean, it's just one of those large companies that have been exposed to silver for so long, and it's kind of like an obvious trade when you think about silver breaking out to new highs. What are you going to buy? What's the largest silver mine or miner in North America, or what are some of the largest? And those are going to be the obvious plays at the beginning, but most things linked to those prices are going to be doing well, in my view. And so I pay attention to that as more of a macro signal. And so I do think that the long-term view for silver-related assets is extremely positive.
Okay. We all like that as silver investors. Okay, he's also asking about the median priced home and silver ratio. So let me pull that up. That is, okay, so here's median priced home, and this is priced in ounces of silver. Today we sit at just south of 11,000 ounces of silver for one home. What do you see with this ratio?
Well, I'm slightly less inclined of taking a view on this, just because the relative performance of look, real estate is part of hard assets. We've been talking here about how hard assets are cheap, and I can't ignore the fact that real estate is also part of that. So I don't want to necessarily be negative on housing prices either, given this environment. Housing prices are also, or houses in general are also, of course, depending on the area. But if we looked at from a general perspective, it certainly is one of the most overvalued across all, hard assets that we can find. And so certainly if you have to favor something, I would say that silver looks a lot more attractive and you have a much better opportunity than housing prices. But I don't know if I have a view on that ratio specifically. I do think that, for instance, you're much better off today, not 20 years ago, not 10 years ago. I think you're better off today owning a house than having a 401k investing in equities, equity prices with CAPE ratio at 30, 35 in the S&P 500. I would much rather own a house. So if, I do pay attention to the U.S. equity market relative to housing prices ratio. I think that's, especially knowing the 1970s, which was a period where the hard assets outperform financial assets, that could take place here again today. So, if you ask me, I would rather own a house than own S&P 500 shares, or of course, it's an index, but or any company that isn't part of that index. And so, I don't know. That's my general view on that. I think house prices can do very well, particularly the ones I bought a house in Latin America just because I think that the wealth effect that we may see in that area could be transformational for real estate investors. But I'm not sure we're going to see the same in the U.S. because of this rotation out of U.S. based assets. But I also wouldn't bet against the housing market either.
Okay. All right. We've got, I'm going to try to wrap some of these silver questions in here from Derek and Andre and Mike. Can't talk specifically about individual securities, but kind of macro here. Okay, Mike's asking, you follow the silver market closely. How long do you see its outperformance of the S&P after this breakout of a 45-year cup and handle? What is your plan for taking profits in the miners as they run?
I think there's going to be all sorts of signals that the market is overvaluing in the mining industry. We can take, for instance, an example, the capex cycle, something I measure very closely. Once we see the capex of the overall industry at record levels and far above what we saw in prior times and so forth, I think those are going to be clear signals that you should be rotating out of those assets. We're so far from that right now. I think once you see a gold to silver ratio below the 40s and 30s, you should start seeing some level of red line or red signs of that you should be transitioning out of that industry. I think when you start seeing a real M&A cycle at its end, where companies are really throwing capital well above the value of what the intrinsic value of an asset really is. Way above, a premium way above what the company generates in free cash flow. Yeah, that's probably, we're probably on the other side of this. I find it interesting as well, the engagement of the government with the MP materials recently, because I think that's going to also be an engagement we're going to see more often in the mining industry that we haven't seen yet. Once we're more at the end of that trend where government has taken stakes in companies, equity stakes in mining companies more often, I think that will help me change my view as well. There's so many of these sort of market peak checklists that we should be considering to have a view about when it's time to be transitioning away. And I don't think we're anywhere close. I should also mention the most important of them all is new supply. Where is the demand versus supply curve today? We know demand is only going higher for many reasons. It's driven initially on the gold side because of central banks. And then you look at the industrial metals and you see, where sort of electricity consumption in the US and globally will likely be in the next 5 to 10 years. And it's probably going to be way higher than where it is currently. What's the infrastructure needed? We're probably going to go through one of the largest construction booms in the U.S. economy we've ever seen in order to create this infrastructure needed for AI in onshoring to take place. And those, so if you start making those calculations, metals are going to be from a demand front a lot higher, and we are not nowhere close to where the supply of those things are. So probably, calculating supply of most metals, I would say, we need a lot more in terms of mining projects to come into fruition in regards to new supply, and majority of the metals are far from those amounts. And so the copper space, we have enough copper underground, but above ground, I mean, it's going to require major investments to see that in the next 5 to 7 years. And that's the case with most industrial metals, most metals that are going to be used in other new developments here as well. So those are the things that are kind of part of my checklist to understand where the mining industry is today. And I think we're just at the beginning. We've seen just the beginning of a movement. The seniors have moved, but no, nothing has really occurred in the junior space, in the exploration space. I think all that needs to be, that capital has to be trickling down into this overall industry. We haven't seen that yet. The catch up of other metals is just starting to happen. We haven't seen those metals become overvalued. I mean, gold is still undervalued on its own. So, when I see gold under overvalued relative to money supply and other things, yeah, I would start changing my opinion. But we're so far from that. I don't even want to think about right now of peak levels because none of those checklists have checked yet.
Okay. All right. So you're looking for increased capital expenditures. You're looking for the gold to silver ratio to get down to 30s or 40s. You're looking for some more mergers and acquisitions to happen in the cycle. You're looking for a lot more government subsidies coming in for these commodity companies. You're looking for the supply deficit to get solved, and a construction boom to happen from all of those events, none of which have happened yet. So we still have a long way to go.
Yeah, and this is why, if you ask me, why my portfolio is very illiquid. I feel comfortable taking an illiquid position on something I believe to be at its very early stages. Now, if I had a different view that, this is going to be a little more cyclical, a 3 to 5 year cycle or something along those lines, no way, and I would be taking this level of risk from a liquidity standpoint. So I think that's aligned with my long-term views. If I'm of that view, I'm okay buying a company in Bolivia. I'm okay buying Latin America because usually those areas and those businesses that operate in those areas, they tend to struggle, particularly from a political standpoint, when resource prices are struggling as well. Those things are usually linked. I mean, if you think about what happened in Venezuela, for instance, just happened to be the case that was exactly the time when oil peaked. Think about what happened in Brazil with car wash operations and all the corruption scandal. That was exactly when iron ore prices, copper prices, and oil prices were all collapsing. So, I'm not of that view at all. I think we're on the other side of that. So, I'm okay taking the risk from a political standpoint, but also from, liquidity as well. I think liquidity will ultimately and inevitably come into this industry.
Okay. All right. So you're willing to take a little higher risk, liquidity, meaning you can't sell it instantly. It's not like cash. It's not like a security that you can just press sell on. You're fine with that because you think this is going to be a very long-term cycle, not one that's going to be short-lived.
Yeah.
Okay, Frankie is asking, let's do macro thoughts. Here's the copper chart going back to the late 80s. What are your macro thoughts on copper?
I think copper is doing what gold did a few years back when it was trying to break out of that 2000 level. And once it did it with authority. I think the same level here would be the dollars per pound. And I think we've just saw that break with authority, and now we're at a price discovery moment, and we're probably going to see much higher prices for copper. Copper is embedded in so many parts of the global economy, and if you believe that we're going to see more electricity consumption, there's really three pillars of that idea. There's energy needs that we're going to have. Natural gas is going to probably be the big answer there. Number two, we're going to see infrastructure changes. As I said, construction is going to be huge. Utility companies are going to be a huge part of that as well. Government spending on that front is going to be huge as well. Pipelines and all sorts of things in the logistics front. And then the third pillar is going to be materials. And I can't imagine a metal that is going to be more involved in that pillar than copper. And so copper is going to be a real significant metal in terms of that, and potentially could be, just looking at copper relative to gold itself. If you think gold is cheap, then look at the copper to gold ratio. We were just getting started in that. We're so far. Copper is so far from gold prices that it's highly unlikely that we're going to see a gold cycle continuation without copper prices also leading the way on the upside. So I'm very optimistic about copper prices. Of course, it's more cyclical. Of course, it has its ups and downs with economy, but over the next 10 years plus, yeah, it's going to be a real opportunity in my view, and something I'm always looking to find exposure to.
Okay, so the tailwinds behind copper, basically the energy demand, infrastructure change, and materials. And here is the gold divided by copper right now. So we can see that as of today, it takes 607 pounds of copper to get 1 ounce of gold. But we just go back here to 2007 and it got below 200. So that would be a massive move right there. And it sounds like one that you're kind of expecting.
Yeah, I do. I do expect that, because that's usually another checklist as well for the cycle too. Is to see copper overvalue relative to gold. I mean, once these metals, to me, macro at the end of the day, macro is almost like a acceptance of risk exercise. You start with gold. Gold is the easy metal to understand. It's the easy metal to get your arms around. It has very low volatility. It's easy to get behind it from a monetary debasement standpoint as well. And then as you make money with gold, which was unthinkable a few years back, and people were all talking. I mean, I remember when we launched our fund, the biggest question we had is, when is Bitcoin going to replace gold? Do you know how often I get that question? Never again. So, because gold is where it is and Bitcoin is where it is now. So, to me, what the change here in that is that now people are looking for, what's the next gold? What's the next thing that's going to move the same way? And that's an acceptance of risk exercise that all of us do. I'm doing it too. And so as we do that and we're willing to take more risk, we start going down to things that have more volatility, that have less liquidity, and you go down to those paths. Eventually you get into the silver environment, eventually you get to the platinum, eventually you get to copper itself. Eventually you get to emerging markets. You start learning that emerging markets have a link to gold prices. And so, why do you think platinum, for instance, has a strong link with gold, with Brazilian equities? Not because Brazil exports platinum. No, it's just because it's an acceptance of risk. And so, platinum has risk relative to gold, and so does Brazilian equities have acceptance of risk relative to U.S. equities. And so all these things have some level of correlation, which I think it's very logical. Copper is doing the same thing. And in my view, there's this overplay of cyclicality aspect of copper that people play, and saying that, you have to have a view about the economy and so forth. The truth is, if you put a chart of gold and a chart of copper over the last 30 years, they kind of follow each other. And so, if you ask me, I think that this is a trend that is likely to stay. And if you're bullish in gold, you're probably going to be bullish in copper long term as well.
Interesting. Okay, so gold and copper. So GC1 exclamation point. And we will do a new price scale. There we go. Oh, wow. Yeah, okay.
It's the same idea. By the way, if you
I
do the
can't believe
same
I've
with
never pulled this up before.
I know it's very normal, by the way. It's not, because we tend to explain this as completely different metals, but they're cousins.
Yeah,
They're of course, look at the outperformance of copper during the time when gold has confirmed that it's in a bull market. This is normal to see as well, and we haven't even seen that yet here.
yeah,
So I suspect that we're going to see that. So game on for copper as well.
yeah, yeah. Man, what a massive outperformance there. Okay. Oh, Sasha is curious. Let me pull this off so we can make it less confusing. Nickel. I'm going to pull up the nickel chart here. Okay, here's nickel futures. And this white line right here is at the 15,000 mark, kind of at the lower end of the chart here. What do you see for nickel?
I don't have any specific views on nickel. I do think it's going to fall into the onshoring idea, and it's hard to believe that nickel is not going to play its battery metal role here, along with others that have been playing that role too. I'm going to mention another metal part of this as well that I think could be interesting for this person who asked about nickel is zinc.
Oh,
I think zinc is to me one of the most interesting, attractive metals on Earth right now. I did calculate something that I think everybody should calculate this. It's an important sort of table I built basically, and I have not reported this to the world because there's so many considerations and ways to calculate this that I think it's sort of unfair sharing this because there's a lot of estimates that go behind that calculation. But basically, it's just looking at where we are with the demand today for each metal relative to how much supply we have above ground, and forget about new supply. So take away the idea of how much new supply is going to come online in the next whatever year or so. Just look at how long would it take for us to run out of certain metals or any commodity if there's no new supply, and you start getting some very strange and weird and scary calculations. Zinc is the one that comes in very first and foremost, one of the first metals that we would run out of. And if you start looking at the number of probably construction spending we'll see. I mean, look at the big, beautiful bill, the expensing that we're going to see from that. It's going to create a real construction boom, in my opinion. As we see those things taking place, zinc is everywhere. It's a galvanization of everything. It's one of the most important metals, along with copper, that are going to be into everything. Every construction will probably be using zinc. As we see that occurring, I highly doubt that zinc demand is not going to change drastically from here. And knowing that it's not like we're going to see major developments of zinc mines in the future. So St. Cristobal, which is the fourth largest silver mine in the world that we acquired, is also one of the largest zinc mines in the world. And the reason why I'm mentioning this is because we as a company have tried to make a real push to acquire new zinc mines. And the more you do that exercise, you start learning there's a real shortage of opportunities out there. And so I think that it's almost like he or she who controls zinc sources or zinc supply will control the world. It's kind of a funny joke, but it's also true. And I think there's very few companies that have a controlling stake in the source of zinc. And so it's a metal that I'm very focused on. And if you look at the prices of zinc versus the price of copper, we were saying how copper is undervalued relative to gold. If that's the case and you think copper is undervalued, then look at copper relative to zinc. It's insanely cheap as well. So I think we're going to see a catch up of zinc prices in a huge way, and it's one of the most important metals to play a critical aspect of construction and all sorts of new developments we may see in the future. So it's a big focus of mine as well.
okay. Does this look like the zinc chart? I've never pulled up zinc before on here. It's saying,
Yeah,
okay, so
yeah.
that is zinc. And you're saying compare it to copper, like divide copper by zinc or what?
No, just put the copper in the same price.
Okay. All right. So copper. Okay. Oh, okay.
There you
Oh, yeah.
go.
So you're saying copper is the yellow here. So
That's
copper
it.
had to move up and zinc really didn't. It kind of went down at the same time. And you're saying
That's right.
this should have a, re-rating. Interesting. Okay.
I think it's going to have a re-rating. So I'm focused on that one. Correct.
Okay. Interesting. All right. Zinc. I did not expect that. Okay. Next, let me stop the share
It's
here.
very cyclical as well. Therefore, why it has a very strong connection. But yeah, I just look. I think we're going to be in a very. You asked about my macro views and at the very beginning of this call, and I just want to caution people because we're going to get into very different worlds at some point. We're in a world where we need a build up period of infrastructure to allow AI to take its course. This build-up process is going to be very inflationary, in my opinion. That's not to say that AI is not deflationary. We're going to have to be very careful with this transition from one side to another. And so right now, I think we're far from that. As I said before, I think it's going to be a checklist you can kind of follow when these things are going to hit their peak. But once that does happen, I think it's going to be a very deflationary world that we're going to be living. And so, yeah, I'm watching for that as well. And I think we're far from that. As I said, I'm not trying to caution anybody on that front, but it's something that I would be paying attention to once that's the right time to be doing so.
Okay. All right. Zinc. We'll start watching that. Okay. Mining stocks, capital, and mergers and acquisitions. Keystone wants to know, can you comment on capital availability and the cost for junior and mid-tier miners and royalty companies? Basically, he's asking about M&A, any current or recent ones that you don't think really make sense. Can you kind of go into any examples?
Sure. Look, I think most of the M&A we've seen, I'm going to try to comment more broadly. But I think that the most of the M&A we've seen so far has been really played out in the course of majors taking out either mid-tiers or majors merging with other majors. That's really what's been happening here more recently. And that's usual, right? That's an acceptance of risk. It's much easier to make those decisions initially. And ultimately, we're going to get to a point where that money is going to trickle down into the exploration side of the industry that we haven't seen just yet. I firmly believe in that. And that's mostly because the depletion of resources across most of the major companies is taking place on a day-to-day basis. And eventually, they're going to have to replace that. And most of the mining companies that have been starved for capital are going to see this. We're starting to see liquidity started to trickle down in this industry, mostly in the junior space. And if you look at the venture capital or the TSX venture, for instance, liquidity has started to move higher. We're seeing this firsthand in our own names in the companies we invest in. We're seeing more liquidity, more new investors, more new shareholders of those places, and that's just part of natural trickle down effect of the industry. And as we see those things occurring, I think that's going to be extremely bullish. Ultimately, you're going to see, in my view, the smaller names outperform the larger names, and we haven't even seen that yet. So, yeah, I'm extremely optimistic about that part of the industry. I think that most of the people that are playing the game of saying that this industry is structurally broken, that we're not going to see money trickle down, are very misinformed and most likely not understanding how history has played its course again in this industry, and eventually an acceptance of risk will take place in this industry as well. And so, yeah, to me, it's a matter of time. So I'm extremely bullish. I think we're getting closer and closer. I think the checklist for that to be unleashed is been checked in many fronts. You're starting to see the outperformance of smaller caps versus large caps. In fact, there's a very interesting chart you can put in there as well. If you take a look at the TSX Venture chart, just take the TSX Venture Index if you have that.
Okay. Let's see. Hang
You're
on.
not sharing your screen right now,
Yeah,
but
let me share my screen here and then we will pull
this
it.
is such an important,
Okay, so
again,
TSX Venture,
yeah, the TSX Venture Capital.
onto stock. I'm not sure how to pull that one up on this. Stock exchange.
TSX Venture is not showing up.
And sure, I'm sure this has it. I just don't know the ticker symbol for it. Venture, futures, Moscow, London. Man, I don't know what the symbol is for it. Huh.
Okay.
Well, maybe you can
Well,
walk us through it. What's
all
it
right.
what's it look like?
If you take a look at gold miners relative to gold ratio, okay, so take, let's say, the Philadelphia Gold and Silver Stock Exchange and look at that relative to gold, for instance. What you're going to see is been in a downward trend for over the last 30 years, and recently it began to tick up, right? Which is what I'm referring to as the beginning of a bull market. As you see, again, acceptance of risk, people are starting to buy the miners versus buying gold. That's just what's been happening recently. And then you take a look at the TSX Venture relative to the gold miners to gold ratio. What you're going to see is that they're exactly the same chart. Why is that? It's because eventually, when the gold miners begin to outperform gold, eventually that means that people are also starting to take risk on the TSX Venture as well. We're just beginning to see that right now. The TSX Venture broke out from I don't know, since '08 or '07 resistance and broke out of that. And the gold miners to gold ratio is just starting to do that as well. So those things are all linked. They're not separated. They're all linked. And so I really believe that on this theory of acceptance of risk, and I believe that's just starting to take place in this industry as well. And eventually, the junior miners are going to be, the ultimate form of the bull cycle here is going to take place as well.
Okay, okay. So you're basically saying that people are now starting to put some money into the gold miners instead of physical gold itself, and that's showing the next part of the cycle.
That's right, and
Okay.
that will in tandem happen with junior miners leading the way to the upside as well.
Okay, okay. So basically, just to kind of recap here, I'll throw some names out. Pan American acquired MAG, Core acquired Silvercrest, Equinox acquired Caliber, and you would expect now these are kind of big companies taking out semi-bigger companies, right? But you could see like a big company taking out the little baby ones, and that'll
Yeah.
tell you that we're further along.
Yes.
Okay.
Yes, we're in the easy category, right? It's
Yeah.
a lot easier for a board of directors agreeing to buy Mag Silver and Silvercrest. Silvercrest is like, extremely high grade. It's a no-brainer. I mean, it's a
Yeah.
no-brainer. If you like silver, what are you going to buy? There it is. So we're seeing the no-brainer transactions happen. That's where we are. And if you're like, at least, I can speak more personally because I've been looking actively for other transactions in the private world. What you're going to find is the private world is very competitive right now. There's plenty parties trying to do exactly the same. And so, you know, do you really think that's not going to take place in the public markets? I mean, I think it will. I mean, I think it's a matter of time. So, yeah, I mean, it's all people are starting to understand that. Look, I mean, one thing I noticed recently is companies that have silver in their name are starting to make a move. Yeah, again, it's like, all right, you like gold, and then you start looking at silver. Silver breaks out. You're like, all right, well, I'm gonna invest in silver names, and then you start looking at silver names, and you type there, it's silver, and there's a bunch of companies, and which ones you're gonna buy? Or we're gonna buy the ones that have silver in their name. They're probably silver related. That's what a normal investor, or not a normal investor, shouldn't say that, but that's what the normal person would do, and that's why you see that reflection in share prices. Now, do I think that that's not going to trickle down to the entire part of the juniors? I actually, I really think that that's it's a matter of time. It's inevitable, and so yeah, I don't think this industry is broken. I think it's just taking its own natural time, and it's coming. It's coming, and I firmly believe in that.
Okay. Sam and Aaron are asking maybe just macro thoughts on oil. What are your macro thoughts on oil?
Look, I think one thing you notice about commodities, and once you get into a cycle of commodities, there's even a strategy to be used here that I have not personally really used. I mean, I use a little bit of that idea, but not, I never thought about building even a fund that only does that. But once you trigger a commodity cycle, which I think we did already, you tend to see is a rotation into the commodities industry. And so you tend to see always a commodities that is the flavor of the month or the flavor of the last 6 months, and always a commodity that is out of favor. And I would say that we saw this with lumber prices initially, then it turned into natural gas, then it turned into ammonia prices, that turned into oil prices. Then we saw the peak of oil when Russia invaded Ukraine, and that was the peak of agricultural commodities. And then we saw metals take off, and then gold prices went to 3,000, and then copper started to move, and then now silver is probably the next one in favor. And look at the other side of it now. You have lots of commodities that have been out of favor now. Now, orange juice not too long was one of the hottest commodities, and now it's one of the worst commodities. There's a clear rotation happening, and I think oil has been sit on the sidelines for some time now. It's been consolidating for a real long time, has been completely priced out the geopolitical premium that it should have, given the fact that we're seeing deglobalization still taking place in the world economy. And so I suspect that oil prices, if you draw a line there from the '08 level,
Oh, wait,
all
right
yeah.
around
If you
here or
can
up
you
here?
can you log this chart?
Yeah,
All
there
right,
we go.
let's log this chart and kind of take out this. If you look
Oh,
at a monthly chart, it's better because it doesn't go negative.
oh, okay.
Uh, Logged monthly.
This is log monthly, but I think it's this one
Just
right here is spiking
Yeah,
us.
just zoom out, not zoom out, but just try to
Oh, do like
ignore
that?
that because it's a negative price. Yeah, try to yeah, you keep going in that.
There we go. Something like that.
Yep. And then now go back and show the other parts. There it is. Go back to wait. There
2008.
it is. There
Okay,
it is. Now draw a line all the way to that peak, all
right
the
here.
way down. Yep. And find your spots there. You're gonna see that 2012 peak level. Yep. Go down, go down, go
Okay,
down.
about like
There it
that.
is. There, that's where you are.
Huh.
So we've been consolidating in oil for some time now. If you look at the peak of 2022, we peaked there during the peak of the invasion, and it's been healthy. In my opinion, it's been a very healthy transition. We respected that support line that used to be a resistance, as you can see in the chart. We broke out of the resistance,
Yeah.
became now support. And I think that support is a real support. We'll probably, we could see $100 a barrel. Uh, I wouldn't take that. Here's another thing that is important about energy. If you're an investor like I am in the mining industry, and you're not hedging your oil exposure, you're out of your mind. That's your biggest risk. If you're a mining company, and you look at the gold to oil ratio, the silver to oil ratio, the copper to oil ratio, all of those things are either at the highest level in history or the second highest level in history. In other words, your margin has never looked so pretty, this pretty before. And I think if you're investor or you're operating a mining company, you're out of your mind if you're not hedging 3 years out of energy cost. I think that's absolutely critical to be doing. So that's your biggest risk. If you're only long mining companies, you probably should have a major position in oil as well, just in case things go the other way. And if you're wrong about it, don't worry about it. Those mining companies are going to still continue to have very hefty margins and are still continue to make money. And that's a positive side of it. But that's your smart hedge, in my view.
Okay, that's a really, really good point because if we're right and the chart does this, the margins in all these mining companies that we're betting on are going to go way down because their costs, all these companies are using a massive amount of diesel to run. Their energy costs are going to go way up, meaning their margins will go down. And this is a nice hedge to it, is basically having some oil in your portfolio.
And Steve, you could have a world where both go up, right? My metal prices go up and energy prices go up, and you make money on both. There's a case to be made that you could see that too. And that's what I call a smart hedge. You can make money on both ways. And let's say you're wrong about it. Maybe there's a case to be made that both could go down together as well. But in the investment world, you got to take risk at some point and you got to have a view on things. And so my view is that metal prices are going to go higher 5 to 10 years. And so if that's your view, how do I hedge that? I think energy is one way. That's certainly something that is really cheap today and certainly completely underallocated across most people.
Yeah, yeah. Okay. Wrapping up here, let's see. Brazil, you're a Brazilian, so this is an appropriate question. Cal is wanting to know your thoughts on owning Brazilian bonds in a diversified portfolio. What's the best way for Americans to gain exposure there? Should we buy them directly from the Brazilian government? I look at that yield and the future growth prospects of Brazil, and they look attractive compared to other emerging markets. What are your thoughts?
I don't disagree. I think you can take double-digit interest rates in Brazil today. Yields are great, especially in the short end of the curve. 1, 2 years out, the Selic rate is, I believe, at a 14.5% or so. So you can take advantage of that now. Of course, the duration is shorter, but I like, I'd never hedge, for instance, the currency exposure in the Brazilian real today. I think that you can take the view that most currencies that have it's not Brazil in this case, but just expanding on that idea. There's two things that usually hurt emerging markets, and those two things usually are a strong dollar and a rising interest rate environment in the U.S. Those two things create a real competitive landscape to invest in Latin America and in emerging markets overall. Structurally, those places are not going to lose what they have in terms of corruption and political risk that they have. I'm not saying we will see that change. And so what you need to see is those factors, become subdued. And once you see that, investors begin to be more comfortable to take the risk in allocating capital there. And so I think you will have that world where you have a weaker dollar and lower rates, and that's going to be a green light for emerging markets. I think a lot of people are seeing the green light on rates and green light on the dollar, but they're not putting the two together. That's a very positive thing for emerging markets. I mean, don't be surprised if you start seeing companies that have very large exposure in Latin America do very well with their earnings if you see the combination of those two factors take place, which they're already taking place. And so I really think that's the case now. And the other thing about Brazil and Latin America in general that I like is the fact that when you look across emerging markets, about 70 to 80% of the index is weighted on Asia. And rightly so in regards to the size of the GDP of China and others. But I really think that in the future, we're going to see more of that capital rotating into Latin America as well for many reasons, especially strategic reasons as well. And the last thing I would say as a catalyst is pay attention to what's happening with the governor of São Paulo as well, which probably would be becoming the kind of leading candidate of elections in the next year. Elections is going to be the biggest catalyst of Brazil, probably, which has been consolidating since the beginning of a big move recently, year to date at least. And as we see that occurring, remember what happened with Argentina. A lot of people think that Argentina started to move after Milei became the president. Not really. It started a year before that. And so where are we today is that people are starting to become more comfortable with the idea that he could be the president. There's a lot of technical reasons why that could happen. We have the left in Brazil today. And when I say the left is we're not talking left of the U.S. We're talking very extreme, sort of more communist ideas. that's losing. It's been losing momentum for some time now, and I highly doubt we're going to see that trend come back in the next, call it 3 years or so. I really don't think that's the case. Lula is the only guy who's been able to bring that popularity. He's 85 years old. He's got cancer. And I'm not saying he will die or anything along those lines. I'm not wishing the death of anybody, but that's, just logically would make sense that you think he's going to pass on to somebody else. And there's nobody behind him. So, who's going to be the next? Well, Bolsonaro is also very weird sort of health issues as well because he's been stabbed, what, 3 years ago or so on, if you guys recall, on some issues that happened in Brazil. And what is likely to happen now is that we're probably going to see a new guy take this into a leading position, which is probably going to be Tarcísio, which the governor of São Paulo. So I'm very bullish Brazil in general. I think Brazil is really cheap. There's a lot of equity exposure that that potentially could be of very attractive for investors in the future. And I don't think a lot of people have really noticed those changes yet.
Okay. All right. So Brazil could definitely be a contrarian play. The counter argument to that is if you see the dollar getting stronger and interest rates going up, then it won't do as well. China. So wrapping up here, Reef wants to know, is China selling bonds because it needs dollars to prop up its own currency? Has this been even more difficult for them as fewer dollars are floating around? He's talking about the ghost cities been propping up their GDP. Has that finally caught up with them? What are your macro thoughts on China?
I've used to have a lot of strong views on China back in the days. We had a fund that had a whole strategy to short China, and the whole core opinion at that time was that we were going to have a Lehman Brothers moment for many reasons, and we did a whole study in the housing market there and the banking system, and we were short a lot of the home builders. We didn't know where that would take place. It was on the currency side, it was on the equity market side. I think that clearly today, in hindsight, that certainly took place more on the equity side. The currency, while it was so cheap to invest against the Chinese currency at the time, it wasn't really where the thesis manifests itself. But in today's world, I would say that majority of the negative views in China have already been reflected in price of assets. And so, you can take a negative view and say things are going to get even worse, but does it have the asymmetry that it used to have? I don't think so. And I don't know. I don't think there's a real story of asymmetry to be negative on China today. And so it wouldn't shock me at all if China surprises everybody on the upside. Am I buying Chinese equities or anything like that? No, but it wouldn't shock me at all if it does well in the next 5 years or so. And mostly because of positioning. I think one thing that is important is in macro, certainly positioning can be when something becomes a very popular view. I remember, talking about China 3 to 5 years ago, it was very difficult to defend that view. Majority of people thought China was going to take over the world, was going to become the largest and the strongest economy in the world. And I always thought that China was closer to implosion than that. And I think that view took place. And now, in this environment now, I don't think the other way either, but I'm also not of the view we're going to see further implosion. I think we've seen a lot of it, and yeah, the only reason I'm not very bullish in China is because it's not a commodity exporter. It does import a lot of commodities. We know that. We know the U.S. is trying to fix a trade deficit that it has structurally with China for many decades now, and I don't know if that's positive for their economy either. I think again, maybe asset prices are a leading indicator of those changes ahead, but yeah, I'm not sure. Yeah, I'm not as negative as I would say the conventional views are out there.
Okay. All right. Not strong enough yet to be buying them, but you're not nearly as negative as you were before.
Well, I think it's also an ethical reshoot for me as well. I mean, I don't know if I want to be buying Chinese equities personally, so that's just my opinion.
Okay.
But do know a lot of people that do that and do very well. I rather do buy other emerging markets that look more attractive and I can get behind it, but for ethical reasons as well. I don't know. Some people will say, "Well, what's the ethical reason of buying Lula's economy?" And I don't think Lula is anywhere close to the CCP personally, but what do I know?
That is an authentic answer. Thank you very much, Tavi. If viewers want to get a hold of you and follow your work, how can they do so?
They can follow my work on X at Tavi Costa or website at Crescat.net if they want to know more. And yeah, always sharing our macro letters there. Should be working on one soon. And I usually share, I don't know, one or two charts a day when I have time to share. And they're usually linked to this long-term ideas. You know, for those looking for short-term ideas, you're following the wrong person here. So.
Right on. Well, thank you very much, Tavi. This was a pleasure. You
My pleasure.
have a great rest of the day.
Thank
And
you.
thank you for tuning in. Go to stevebartonmoney.com for more and have a wonderful day.